All righty. Hello, everyone. So, as always, live streams, I gotta check. Can you give me a little thumbs up or say, hey, if you can hear me? And I'm not, it doesn't sound like you can't hear me at all. And then we'll jump in here pretty quickly. Hey, Will. All right, you can hear me. Cool. So if the audio ever sounds like bad or it gets like weird and clippy, just let me know and I can change that. But cool. So we're on ins. No, I can't hear you, Will. I'll wave to you though. I think is that what it does? Oh shoot. All right. Cool. Well, welcome everyone. So tonight we're going to go through just a live Q&A, and I also want to show you a little bit of this max purchase price calculator that I have that I've just put out, I think 2 or 3 days ago, which has been, it seems like it's gone on, it's had a pretty good response. Like I've had hundreds of people who have downloaded this or copied it into their Google Drive, which is wild because I had to like upgrade my software because so many people were requesting this download. So what I want to do first is let's get around to that here in a second, but um, let's just go through some questions here. So you're welcome to leave those in the chat, either on Instagram or YouTube, and we'll just kind of run through these here. All right. So let me jump over here. So Devin, you asked, so when I make 50,000 a year, I'm guessing, and contribute 20,000 to maxing the 401k, the take home will be about 25. Is the pre-approval for the loan based on 50,000 or 25,000? So your the amount that you get pre-approved for is based on your gross income only. So when you're looking at how much is actually comfortable for you to spend, of course you want to go with what your take-home pay is. But a lender doesn't view any of those deductions from your pay stub as things that they need to take into consideration. They're going to give you a loan based entirely on your gross amount, no matter how much is taken from your paycheck. Um, Robert, so you asked, is it a good idea to fill out a few applications to get pre-approved? Absolutely. So I would recommend getting pre-approved with a credit union, a local credit union, a big lender, so like Chase or Quicken Loans or Wells Fargo, and then a local mortgage broker as well. So you get kind of a good spread of different loan options for you. Okay, so is it possible to get a home loan with a 670 credit score? Absolutely. So as long as you have above a 640, you should have a pretty good chance of getting a loan. Most lenders are setting their bare minimum at around 640 right now with COVID. Oh my goodness, this is going to be a game of can I catch up with these? We got Jaime Resendez. So how much can you buy with $1 million? Is this $1 million a month or $1 million a year? Not that it matters, I guess. I think once you're up to that point, you're doing pretty well. I'm gonna guess you could probably afford maybe outskirts of California. I don't know. I think it really depends. Okay, so Tiffany, you asked, what should a lender be providing me so I know for a fact if I've been pre-approved for a loan? Um, you should get a pre-approval letter. So some letter from the lender that says, hey, you've been approved for this amount, and then maybe have an additional piece of paperwork that gives you like a quote and a breakdown of fees. At minimum, that's what you should be getting. So if you're at the point where you feel like you don't know if you've been approved, then you might not be approved yet because a lender should be very excited to give you a pre-approval letter because that means you're ready to go shop for a home, and that means they can actually help you with a loan. Um, I can't imagine a circumstance where a lender wouldn't be excited to give you that give you that information. Uh, so what I would do is just follow up with them and say, hey, can I get an idea of what kind of status we're at with the pre-approval? Okay. So, is it mandatory to have 2 years self-employment to get a loan even when everything else looks great? So, uh, yes and no. It depends on what your job was before the 2 years of self-employment. So, if you were in the same field, you can actually qualify just based off of 1 year of tax returns with self-employed income. So, for instance, let's say you're a graphic designer and you worked with a company, you got a W 2 at the end of the year as a graphic designer, and then you wanted to go start freelancing. So, as long as you have 1 year of that freelance work, you now are able to put together and use that 1 year of self employed income. If your employment before being self employed was completely different, like you were a teacher and now you want to become a graphic designer, then you have to have 2 years of self employment there. Okay. Um, Jose, you asked with FHA, can you refinance again? And were the stipulations, if any, can you get a cash out? All right, so yeah, you can refinance as much as you like. FHA has a really nice benefit of a loan that they call a FHA Streamline. And there's a couple different types of FHA Streamlines, but the common one is what's called a non credit qualifying Streamline. Basically, uh, no checking of credit, no checking of income, and no appraisal to be able to lower your interest rate, which is fantastic. So, yeah, there's no limits on refinancing on that FHA, um, except for there's a time limit. So you're going to expect 6 months of a wait minimum between refinances. And in any way, you probably don't want to refinance more than like once a year. And even once a year is probably going to be costly for a refinance. And you can't get a cash out on FHA. If you get a cash out, you're going to need an appraisal and a full credit report, full income analysis with the underwriter, and they limit it to 80% of the value. So you need 20% equity remaining in your home if you're going to do an FHA cash out. Adam, you said Q&A will be better than the debate tonight. Man, I probably I'll try. I'll do my best, but I don't think I'll be as entertaining as the debate might be. And honestly, I kind of forgot that it was going on tonight. That's my bad. I normally just watch the replay anyways, so um, I should have planned ahead. Okay, you want to buy a house September of next year. When should you start the process? Um, Really, I don't think there's ever a time that's too early. Um, as far as when should you talk with a lender and a realtor, what I would first want to do is maybe about 3 months before you start uh, getting more serious about for September next year, go ahead and connect with a lender about 3 months before that and let them know, like, hey, this is about 3 months in the future. I want to do a soft pull. I just want to get a general idea. Is there anything that I need to work on? Because the hard part is trying to figure out what do you need to work on yourself. And that's where a lot of stress comes into play. So I would do that as early as you can. Let them know that you're not looking at purchasing super soon, so they're not chasing you down the entire time. But that will help them or help you be able to get a really good game plan of either I'm in a great spot or these are the things I need to work on in the next 3 months to get going. Um, Tiffany asks, should a lender send both myself and realtor a direct underwriting pre-approval letter, or is that something only sent to your realtor? Really, it's something that should only be sent to you. Uh, it kind of gets into a little bit of like, I don't know what the right word is, if it's ethics or privacy. Really, a lender only works for you. They don't work with a realtor in any capacity, right? They don't work for a realtor. So sending your personal information to a realtor can be a little bit of a it's just an interesting conversation. So normally it's not a huge deal, but ideally a lender would be sending things to you and you would be sending them to your realtor, or you'd give permission to the lender to send it to your realtor, especially if it's a listing agent. When it's your agent, then you know a lot of stuff is okay. But if it's a listing agent, a lender really shouldn't be sharing any information with the listing agent. Anything with the listing agent should be handled by your agent, your buyer's agent. Simon, you asked you mentioned to try and take care of high interest credit cards, but you still own the credit cards unless it's worth it to actually close the accounts. So it will hurt your credit quite a bit if you close your account. So don't close your accounts. What I would suggest doing is either keep a very small balance on them, or use it once a month to go buy a pack of gum or gas or something and pay it off, just to keep your card active. Because uh, you close your account, what ends up happening is you just completely wiped out your average age of accounts for that credit line. So let's say like the average age of all of your credit lines were 8 years, and then you close an account. Well, that might drop your average age down to 6 years, which will in turn lower your credit score. It's also going to take off a trade line, which is going to lower your credit score as well. So keep it open, don't close it. That's going to help keep your score up there. Um, Okay, so you're looking to purchase a home in May 2021. What month do I think you should start the process? Meaning getting approved and find a realtor. Again, I'd do it like 3 months before, so maybe February, start that process. And the reason why I would start so early is you have time to create a plan if you need to work on some stuff. But then you're not in this like crunch to figure stuff out, because by the time you're in it, at least what I've seen most of the time is you're gonna start in February, and then it's probably only gonna take you like a month or 2 before you start looking at homes, because the real estate world moves pretty fast, and when you start looking at houses, you're gonna end up seeing something like, "Oh, I really like that one," and at least that's what I've seen in the past. So I would try to get a head start on that as early as possible. Okay, let's see here. Can you use a cashier's check if it's been gifted to you as a gift for closing cost and down payment? Yeah, you can use a cashier's check. It depends on the loan program on how you have to document that, but a lender is going to normally want to see a copy of the cashier's check, a copy of your statement after it's deposited into your bank account, and a copy of the donor's statement. And the donor needs to be like a family member. Can't just be like a friend. So as long as you have those things, cashier's check, no problem. Doesn't matter if it's a wire or a check or um, cash is usually not good. Robert, so you said you talked to a mortgage company and they told you that you need at least a 620 score and you have a 610. So a lot of lenders have raised their credit score minimums. Now, it depends on what loan program you're looking at and what lender you're working with. Because I still know of lenders that are doing down to a 500 credit score on an FHA loan, on VA loans, on USDA loans. The minimum for credit score for a conventional loan is 620. So it depends again what kind of loan you're looking at. If you have a 610, you're going to need an FHA loan, USDA, or VA loan. One lender that you could use is Carrington if you can't find any other options, FHA. Most lenders with COVID are requiring a 640 on FHA loans, so it's something to be mindful of. But you're talking about 30 points. I would see if you could go back to that mortgage company and ask them if they can run a credit simulator to figure out what you can do to get your score up to 30 points. That's going to be your best bet, because right now going with a lender who is going to approve a loan with a 610 credit score probably is going to be more expensive than maybe waiting a little bit, increasing your score 30 points, and then taking an FHA loan at that 640. When looking at a home, should I make sure to include the HOA fee in the loan amount, making sure not to exceed what I was approved for? So the HOA fee is not going to be included in the loan amount. The HOA fee is going to be a monthly payment. Okay, that's going to be calculated by the lender. Now, the HOA itself might only charge annually or semi-annually, quarterly, monthly. It depends on each HOA. But the HOA is going to be a monthly factor, not a factor actually inside your loan because it's an ongoing payment. Okay, you'd like to buy a house and refi your current house next year. What should I do first? Really, whatever makes sense. Like if a refinance right now makes sense, go for that. If a purchase right now makes sense, go for that. Uh, you can actually do them at the same time. You just have to let each lender know, or if it's the same lender, they'll know about it. But the order in which you do it is not going to matter at all. Just make the best choice independently for each one. Man, I'm afraid to cough. I promise I don't have COVID that I know of right now. Oh yeah, and some people are asking on Instagram. I am live on YouTube, and yeah, I do need to hop over here back to Instagram because some people have asked. Okay, so Mikey asked, "What do you think of purchasing a one bed, one bath condo for a first time buyer? Do I think that's a good investment?" Um, so you're in Nashville. I'm not too familiar with like the Nashville market in terms of what's going to be good real estate for you there. I do know when you're talking about one bed, one bath, what you're doing is you're limiting the pool of who's going to purchase that home. You're mainly only looking at people who are looking for a smaller place. So most likely, people who are single. So you're limiting the pool that you have to sell that home or rent that home to. So normally, the more beds you have, obviously up to a limit, is going to be more attractive when you go to sell that home or rent it, and it's going to be probably easier to get a higher rental or purchase price out of that, and a higher resale value. What happens if a spouse is furloughed? Will the underwriter ignore their pay? Yeah, so if you're furloughed, then the underwriter can't use that pay because it's not continuing. So you'll need to be back on the job, normally enough to get one pay stub for the lender to be able to use that income. Kyle, you asked, do you know how far back the mortgage lender will look back at a large bank deposit to make sure it's not borrowed money? You got a loan for 23,000 and won't be buying for another 2 years. Yeah, so the lender will only look back 2 months max. So two bank statements back. That's all they're looking at. So literally, you could go take out a loan for let's say $25,000, wait 2 months, and then purchase a home. And you can actually use that loan, whether it's unsecured or not. Now, the lender is going to know that you have that loan because it's going to show up in your credit report. But at that point, they don't care that you're using borrowed money to purchase. It just, at that point, after the 2 month period passes, they don't ask questions anymore. Now, the only stipulation with that is like if your mortgage process went on longer. So let's say, trying to think of a good example. I can't think of a good example off the top of my head, but basically, if the lender ever sees a statement with that deposit in it, then they have to question it. But they only have to look back 2 months. What is my advice for new loan officers? That's a great question. I need to think about for a second. Really, what I would suggest is trying to find something that helps you stand out a little bit differently. So, for instance, like what I did when I started out was I went really heavy into video. So, like, that's why I'm here right now. Uh, like, I used BombBomb or Wistia Soapbox. Those are really great to be able to interact with people and help them through, like, and navigate these really stressful documents and this really stressful process. So, I'd figure out something like that. Is video something that can help you kind of set yourself apart out there? Um, or if not, maybe find another option that's going to help you kind of be different than what everyone else is doing. And maybe try to stay away from cold calling realtors because they seem to not they seem to not like that too much. What do lenders require when applying? So I actually have a video on that on what mortgage documents are required. So you can go type in YouTube mortgage documents required, win the house you love, and I have a video talking about all the documents that you need. And then getting approved for new construction uh, won't be any different than getting approved for another loan. New construction, you might run into a little bit more strict requirements. It depends on the builder and the lender and if they have any requirements there. But you should have a pretty similar process from new construction to a home that's already existing. So you said, thanks for making these videos. You are welcome. Let's see here. What other questions do we have? I want to make sure I don't miss any here on Instagram. Is there anything a buyer can do to speed up the title search process, even if they're working with an attorney? Really, the only way you can speed up the title search process is having the title company work faster. Now, this depends on like how good the county is, because a lot of title companies are really great at what they do, but the counties themselves maybe are a little slow. So that can kind of hinder the process a little bit with the title search, but the title search should be pretty quick. A really good title company is going to get a title search back, within, I would say, under a week, um, unless there's any issues. As long as it's like a clean title, there's no problems, there's no remaining liens or things that are still, uh, you know, payoffs that were unrecorded or something. Then it should take only a couple days to a week, I would imagine. So you want to know about what loan product can you qualify for if you want to buy vacant land. So you'll need a specific like lot loan, and a lot loan is not conventional. It's not FHA. It's not VA. It's not USDA. It's not like the big four loan types. You need a specific lot loan for land, and I'd recommend going to a credit union and seeing what options they have available for you. Your down payment's normally going to be a lot higher, like 25 to 30%. I'm not sure what the interest rates are on land loans, but you'll need a specific land loan unless you're looking at building on it immediately. Okay, so what I'm going to do is I'm going to take a quick break here from the questions, and we're going to hop over to this max purchase price calculator. I'm going to show you a couple things with it. If you're on Instagram, what can I do? Can I flip this? I'm going to flip this and point it at my screen. Let's do this. I don't even know if that's going to be helpful or not. Probably not. But we'll see. All right, so give me a thumbs up in the comments if you can see my screen. And you know what? It's not going to be helpful on Instagram. Sorry. Okay. So up here on my screen is this max purchase price calculator. So what it's here to do is to tell you only what you could afford or what you could be approved for from a lender. Um, because sometimes the hardest thing to figure out is what will a lender actually give you money for. So uh, someone said elbow cough. Did I cough? Did I not cough in my elbow? Oh man. Lost my train of thought here. So this is what you could afford, not what you should afford. All right. Or what you should pay, because a lender is going to qualify you based off of your gross income. And a lender is not a financial advisor. So uh, don't count on a lender to give you good advice on what you can afford. This is only to show you what the lending guidelines say about what you could get approved for as a general estimate. So what I'm going to do is let me see, hop over here at someone asked about a $60,000 salary. So what you can first do is put in what your yearly income is, and this is going to be gross income here, so before tax income. And then you can also add on a co-borrower. So if someone else is on the loan with you. So what we'll do is, let's say we want to run with a $60,000 a year income. So let's say I'll do 50 and 30. Let's say our co-borrower has a $30,000 per year income. All right. So over here on the right, we can see combined monthly income is $6,667. And I even put in the cell a little thing that says what the take-home pay is. So I'm estimating taxes in here, but estimated take-home pay would be about $5,333. So you're normally taking home a lot less because of taxes. So it's important to see that number as far as what you actually can afford in your budget, not what a lender would approve you for. So after you're entering your income, you want to go ahead and put in your debts. And I put in 10 slots here. So this should be enough to cover. If you need more, then I would just kind of group together some of those debts here. But um, so what you'll first list out is, we'll put in, let's say, a car payment. Let's say our car payment's $350 a month. Let's put in student loans. And let's say we're on a conventional loan. So, maybe we're on an income-based payment plan. Actually, let's do that for the co-borrower. So let's say our student loans are $250 a month. And then we have a credit card, and that's 200. Now, there are people in the comments who sometimes will like tell me or tell people what you can and can't do. I don't think it's I don't think it's smart or beneficial to anybody to, you know, go and chastise other people's decisions about, purchasing a home if they have credit card debt, or purchasing a home if they have a car loan. Um, that's just, I don't think, helpful to anybody. So you're the only one who knows your financial position, and specifically where you're at. So make the most wise decision that you can, and don't chastise other people's decisions if they make them. Um, so that's my little word there. So let's go ahead and fill out the co-borrower's yearly income. Let's say that they have a car loan as well. We'll say theirs is a little bit cheaper here. Let's say they have student loans, and let's say they're on an income-based repayment plan. Um, and on a conventional loan, we can actually use a $0 a month if that's what they're paying on an income-based repayment plan. And then let's also include child support. So child support and alimony aren't technically debts, but they're actually calculated as debts in your debt to income ratio. So something to be mindful of. Let's say child support here is $300 a month. So what this is going to do is calculate how much monthly debt we pay for each person. So on our side, we pay $800 a month in debt. On the co-borrower side, we pay $600 a month in debt. And then up here, this is going to total our monthly debts for us. So combined, we pay $1,400 per month in debts. All right. So uh, then what we can see is how much a lender is going to approve in our total debt. So a lender is going to look at your finances, your income and your credit, and they want to see what's the max amount of debt they're comfortable with you having. And again, this is not has nothing to do with budgeting. This is all about risk for the lender. A lender's only concern is, are they going to get their money back? A lender does not have like a legal or an ethical obligation to tell you how much you should be paying for a home, or you should take out in a loan. The only thing they have an ethical and legal obligation to is, um, checking your ability to repay, which all of these guidelines follow inside of ability to repay rules, and is the risk layer good for them, right? Do they feel like they're going to get their money back? So, um, let's see. So then after that, you have your max housing payment. So lenders look at your debt to income ratio in two ways. There's a front end housing ratio and a back end debt to income ratio. So front end housing ratio is your projected mortgage payment divided by your total income. Your max monthly debt, or your back end debt to income ratio, is your total debt. So projected housing payment plus debts divided by your income. So it can be a little tricky, and that's what this calculator does. Is it's trying to take out all of the math that you have to do on your own. But sometimes it's helpful to see kind of what's going on here. But um, what this is going to do in this calculator is auto fill in this purchase price for us. So we can see that with this income, um, and Uh, I just realized I think I meant to do 60,000 and we're doing 80,000. That's okay. Uh, so with this income and with these debts, we can afford a $283,991 house. And over here on the left, we can kind of refine this a little bit more. So we can first go with our down payment. So we can see, uh, 20% right now. Maybe we actually want to do 5% down. So we can see that actually changes our max purchase price here. And then we can also change the interest rate. Right? Watch if I go from a 3% interest rate to a 5% interest rate, how much less we can qualify for. So 212 to 253. So talking about a difference of $40,000 just by changing the interest rate here. In here, we have tax rate and insurance rate. So if you're not familiar with what those rates would be for you and in your local area, you can leave these as kind of a good rough estimate here. And all of these numbers are going to translate over into your monthly payments over here for you as well. So in here is where you can put in your HOA. I know we had that question about HOA earlier. So what you can do is, maybe your HOA is, let's say it's, I don't know, $500 a year. Are we getting spam comments about stock trading? All right, interesting. So you can put in your yearly HOA, and then what this is going to do is calculate your HOA monthly that you would be paying that gets included in your debt to income ratio. And you can see having an HOA is going to decrease the amount that you can purchase within a max housing payment. You can also put in mortgage insurance. If you hover over this, what this is going to do is show you different loan types and their mortgage insurance. Now, this calculator is not perfect. It doesn't have every single thing in here, or else I'd literally have to hire a software developer to do all of the ins and outs of everything in here. But this should give you a good idea. If we're going to go with a conventional loan, less than 20% down, I want to put in this number, 0.006. And that's going to input mortgage insurance in here for us. And then not finally, we can put in the years. So are we going to be in the home for 30 years? Are we going to be in it for 15? So if I bring this over to 15 here, we can see we can afford a lot less on a 15-year, keeping the housing payment the exact same. And then finally, this is where people can get a little frustrated. This is the debt to income ratio. So these are the two debt to income ratios. So the max housing ratio. This number is going to be multiplied times your gross income. So for instance, we said in this scenario, our combined monthly income was $6,600 per month. A lender will take this number times this number, and that's the maximum amount that they'll allow for your housing payment. The max they'll allow for your mortgage payment. And then they'll take this number, your max debt to income ratio, times this number. And that's the maximum allowance of debt that you can have each month, which is this number right here. So this calculator automatically figures out which one of these is the highest for you. So you don't have to worry about doing any of that math in your head. You can see kind of the formula up here that's going to figure that out for you, so you don't have to worry about it, which is nice and took me way too long to figure out how to do this in Google Sheets. But what you can do is you can actually change these numbers. So if you were on, let's say you had a high credit score and you were doing a conventional loan. Well, conventional loan's actually going to allow you to go up to 49% debt to income ratio. And we can see, obviously, that skyrocketed how much we could purchase. And the front end ratio actually on conventional loans doesn't exist. So we could bring this all the way up and see how much more we can qualify when we push the limits of how much a lender is going to give us. Now, the bad thing about this is, we can see our max housing payment is $3,000. This is 57% of our take home pay. So this is here to demonstrate to you that just because a lender is going to give you money doesn't mean you should take it at all. And I'm going to go in here and I need to kind of block some people here who are spamming WhatsApp and trading advice, I guess. I don't know. So let me know if you have any questions about this calculator. But what we'll do is we'll go ahead and hop back over here in just a second. One quick note is that the way that this is built, if you're familiar with Excel or Google Sheets. It's built on what's called iterative calculation. So it's all circular reference, meaning that the sheet is trying to figure out how to make this number work with this number and all of these numbers as well. So it's trying to match them all together in this weird mesh. So if you do one thing a little bit wrong, the whole thing's going to mess up. So for instance, let's take our insurance rate here. And if I said our insurance rate was 75, now 75% instead of 0.75%, you can see everything just goes crazy up into the millions. And even when we try to put this back, it's just not going to work. So what you can do here is you can actually copy this formula, delete this. Actually, don't delete it. Zero it out. And then paste it back in here again if you want to. This is not working for me right now, of course. Or what you can do is you can copy this link down here and it's going to make you a new one. So just know if you mess it up and it gets into the millions, it's okay. You'll be all right. Just copy a new sheet from this link here, or cancel out this formula in here if you're familiar with that. So let's go back to some Q&A because I know I'm definitely behind here. And everyone on Instagram hopped off because they can't see the screen, which is fine. Totally understand it. Let me scroll back up here a little bit. So Michael, yes, there is a link to the calculator. Go into the community section of, actually, you know what? Let me just send you a link to it. That will be easier. I'll throw a link here in the chat. Okay, so I did throw this link here in the chat. So you can go ahead and click on that and get that downloaded there. So when can a borrower back out from the lender that issued the original pre-approval letter? Whenever you want. A pre-approval letter is not binding at all. So you don't have to worry ever about that. If you don't want to go with a lender, just let them know. Rita said, I'm working with a loan officer who tells me he's going to call me back, but I have to chase him down. I'm already pre-approved and uh, do I change loan officers without another inquiry? Oh, okay. So if it's in a 45-day window, you can get your credit pulled as many times without it counting as an additional inquiry. So yeah, if your lender is not responding to you, then I would say, yeah, go ahead and move on to another one. That's just going to make things a little bit easier for you. Why do we always use gross income for the calculation? Great question. It's just the way the lending rules are made. It's with every single lender. It'd be nice if it was different, but it's not, unfortunately. Okay, so in the calculator, are you including monthly expenses or just debt? So a lender is only going to look at debt. A lender is, again, they're not a financial advisor. Their only concern is, do they feel like they're giving out the appropriate risk so that they'll get paid back on that loan? Are they going to get their money back? That's all that they care about. They're not your financial advisor. So they're not going to look at your expenses. You have to do budgeting before you go to purchase a home, to be able to see, can you actually afford something? So, for instance, like gas, groceries, all the other things that you spend money on, excessive amounts of coffee, that's not going to be calculated by the lender. Only debts will. Have I noticed that underwriters are being extra picky and asking for extra documentation from buyers who took a forbearance on their loan during the early phase of the pandemic? Underwriters are being extra picky in general. It's just the nature of what's happening with the pandemic. So it's nothing I would take personal. It's just the underwriters are trying to do their job, because if they do their job wrong, or they miss something, or a loan defaults, it's not very good for them. So keep in mind that what happens for an underwriter is, when your loan closes, the lender doesn't just have this mortgage now and they get to never worry about it again. What ends up happening is that mortgage most of the time is being sold to um, Fannie Mae or Freddie Mac, or it's being sold on a secondary market wrapped up into a bunch of other bonds. So this is how the whole secondary market works and how money cycles through the economy, which we won't get too into. But what happens is you have these regulators and you have these enterprises who are actually looking at these loans now. And let's say that you have this loan and this underwriter checked everything. And then a year in the future, you start missing payments. Well, somebody who purchased that loan is now going to come back to you or come back to the underwriter and say, you underwrote this loan. They're now not making payments on it. You told us that they were good to make payments. What's going on here? So now they want an explanation for what's going on with these underwriting, uh, the underwriting on these loans. So if there's a pattern of underwriters or companies having loans that are defaulting or people who are missing payments on these loans, then they're going to start looking into these underwriters a little bit more and say, what are we missing here? What's going wrong that this loan was supposed to be good to go, but now people are missing payments on it, and it kind of messes up the whole back end of the economy. It's why we had the whole 2008 housing crash. Is we had bad underwriting, bad loans, people not making payments, and that's how everything kind of fell apart after that. Is it true that I have to make 3 consecutive payments and be out of forbearance to be able to purchase or refi? So it depends. I have a video actually on this of purchasing a home after forbearance. So go ahead and check that out. It's going to show you all the circumstances in which that's the case. But most of the time, you're going to need 3 months out of a forbearance plan. It depends on the loan type as well. But that's going to be your easiest solution moving forward. And as far as a purchase, the you're going to be immediately taken out of forbearance when that loan gets paid off. So the purchase you don't have to wait, but normally on a refi you do. Is there any way to include a husband's income and not credit score in Texas? There's nowhere in the nation, no loan program that I know of that you can include income but not credit. Okay, can you pull a loan out from your 401k for your down payment, especially now since you don't get the penalty of 10%? Yeah, you can do a loan for a down payment from your 401k, and it's actually not going to be counted in your debt to income ratio, which is super nice because a 401k loan, you're actually paying yourself back. It's not an actual true debt because it's secured. Uh, it's secured by an asset. How long does underwriting take after appraisal is complete? Really depends lender to lender and your unique situation. Um, so, what I would expect is in a very normal circumstance, from the beginning of when you sign your contract to buy a home to the very end of the closing table, I would expect an average of 30 days. Your appraisal is probably going to be done in the middle of that. So I imagine if you've had the appraisal done, you're probably around the halfway mark with your purchase. Okay. So Terrell, you asked me to do a income of 52,000 and monthly debt of 125. Sure, I can do that. Um, let's see here. Let me clear out everything. I don't know what your debt is, but we'll just say we'll call it debt. If your debt is 125 a month and you have a yearly income of 52,000, you'll want to play with these numbers down here, but this would be an aggressive estimate. If you're going more conservative, you can kind of hover over here to see what these numbers might be. And a conservative estimate for you would be 186 with a 5% down payment. And you can see this breakdown here. I'm actually going to clear out the HOA. That would bring you up to 193. And again, very conservative estimate. If you have a high credit score and you're going with a conventional loan, oops, then you could actually bring this up to 49% and bring this up closer to 454, 45%, and bring that number up. And actually, on a conventional loan, you could actually take it up to 49 if you have a really high credit score. So, hope that helps out. Okay, how long does it take your score to bounce back up after an inquiry for mortgage? It really, so an inquiry for mortgage should only affect your score anywhere from 0 to 5 points. So it's not going to be a huge impact. Um, but how long it takes to come back, I would expect maybe a month, maybe 2 months tops. But again, it's only going to impact your score literally 0 to 5 points. Okay, so are lenders requiring borrowers to reserve or to have reserves or savings after closing costs? Yes, and it depends on your loan type. Normally, FHA loans require a lot more reserves than conventional loans do. But uh, basically, a reserve is 1 month of a mortgage payment. So your lender might require 3 months reserves. So if your mortgage payment is $1,000 a month, that's $3,000. And that's the money that you need to have in your bank account after closing. So after paying your down payment, after paying your closing costs, they just want to make sure you're not wiping out your bank account. So that's your money. It's not a fee. It's you don't have to go use it on anything. They just want to see that you didn't completely drain your bank account. Because imagine a lender is seeing, let's say your total cash to close, the money that you have to bring to closing is $15,000, and then all they see in your bank account is 15,000. That starts to make them think, well, will you have enough money to move in and fix things if they break and make the first payment? So sometimes they require reserves, especially with COVID, that's increased a little bit. How long are pre-approvals good for? Normally about 90 days, which is about how long a credit report lasts until it expires. Upfront mortgage insurance. So upfront mortgage insurance is required on FHA loans, and it's 1.75% of a loan amount. So if your loan amount is $100,000, you're actually going to take out a loan for $101,750. So it's normally wrapped into your total loan amount, and it's not a fee that you have to bring at closing. It's going to be wrapped into your loan amount, but FHA charges an upfront mortgage insurance premium plus a mortgage insurance premium for just monthly mortgage insurance. So FHA loans can be kind of expensive. Conventionals are a better route if you have a higher credit score. House hacking, is it a viable option? What are your thoughts? House hacking is absolutely a viable option. House hacking is effectively, I guess there's multiple types, but the one I'm more familiar with is, let's say you're going to buy let's say you buy a duplex, you live in one unit and rent out the other. So effectively, someone's kind of paying the mortgage for you. That's where the house hacking thing comes in. And since it's technically a primary residence, since you're living in it, you get to take advantage of low interest rates and low credit scores compared to an actual investment property. Because if you did an FHA 2 unit home and you lived in it, you can do a minimum of 3.5% down, and your interest rate's going to be really low. Compare that if you did a conventional loan, you're going to be looking at doing, I can't remember off the top of my head if a 2 unit is, I believe 20% down or 25% down. You're going to have to put a higher down payment on a conventional loan and get a higher interest rate because it's an investment property. All right, we got Wisdom who said realtor from Atlanta, Georgia. Welcome. So if you're in Atlanta, Georgia, reach out to her. I'm sure she'll be able to help you out. I've never been to Georgia. I think I need to go to Georgia at some point. Okay, what does employment verification consist of? There's multiple different types of employment verification. So you have a written verification of employment. It's called Fannie Mae Form 1005. And basically, what it is, it's a document sent to your employer. So, like a manager or HR rep or some sort of boss, and they're just going to ask questions about your employment and pay. So, what's your pay been over the past 2 years, broken down? So, bonuses, overtime, all that jazz. And then, what's your likelihood of receiving a raise in the future? When was your last pay raise? So, just the basic stuff that's pretty much already in all of the other things you sent to the lender. The frustrating thing about loans is like you're sending in pay stubs and W 2s and tax returns and verifications of employment. It's all saying the same thing, but they want to double and triple and quadruple check that your income is what it says it is, and they're also trying to limit fraud happening with the mortgage process as well. Oh, there's also a verbal verification of employment. Normally happens about 10 days before you close. And that's where the lender is going to call your employer and say, hey, does Justin still work there? And hopefully somebody says yes. And you do indeed still work there, because you can get laid off before you purchase a home, and you're not going to get the loan anymore. I had I had a circumstance where so I'm a broker. So we basically work with lenders and connect them with buyers. And so we're working with the lender to facilitate a deal closing, but ultimately the lender is the one who secures and gives the loan. And so we closed on it. They did a verification of employment. Everything was fine. And then literally a year later, I get a call from an auditor who says, hey, we looked up in records, and this is why all of this stuff gets so detailed and documented, because you have auditors who are looking at things from the past. And a year later, an auditor talked to me and said, verification was done on day 10, and on day 9 before closing, the buyers actually quit their job. Both of them did, and didn't tell anybody. And then at closing, they signed something certifying they were still working. So that is what we call mortgage fraud. And even with doing multiple checks, a lender can't guarantee that they're going to catch everything, because it would just be impossible. You'd have to be asking every single day, are you still employed? Are you still employed? You're going to sign something at closing certifying that you are. So it's better just to be honest than not, because mortgage fraud is not a good thing to do. In that circumstance, nobody got in trouble, but what most likely happened is they were well, number one, they had to resend in pay stubs a year later. Otherwise, the lender could foreclose on them for committing mortgage fraud or possibly press charges. And most likely, their names are entered in a database saying that this happened. So future lenders can determine if they actually want to lend to them or not. So it can be a little scary. Just be honest with your lender, even if it's a bad situation and you don't want to be honest about it. Just be as honest as you can. Okay, so is there a way to do closing online? Yes, it depends on what lender and title company you're working with. Not all are set up to do it. Only some are, but yeah, you absolutely can do it online. It's pretty cool. I've only done one virtual closing before, but it was awesome. Like it was basically a system where the buyers could sign in anytime they wanted to a notary and sign it whenever they wanted. So there was no time restriction or everyone having to come in. So just check with your lender before you start the process to see if they do an e-closing for you or a digital closing. Does the loan officer check your credit again as your closing day approaches? So, in the very beginning, you'll have hard inquiry, so a full credit report check. And then, normally, a couple days before closing, they'll do a soft credit pull. And the soft credit pull is not going to impact your credit score. All it's going to do is going to tell the lender, like, hey, did you go did you go buy a car? Did you go buy a boat before you purchase a home? Is that going to throw off your debt to income ratio? That's all they want that for. They don't really care what your credit score is. Normally, they're going to pull a soft pull that doesn't even show a credit score. It's called a refresh report, and all it does is show the lender, like, did you go buy something that they don't know about. But hopefully you didn't go take out a bunch of debt before you close. Why is my lender making me pay upfront mortgage insurance if it's already included in my loan? So what I imagine is happening um, is because I know exactly what you're talking about. I want you to look at your loan estimate. Uh, so your loan estimate in section B, it's, let me see if I can remember all the section things from my head. In section B, it's going to say FHA upfront mortgage insurance premium, and that's probably what you're seeing there. The way that the law is written is that a lender has to itemize everything that's included in your loan, even if it's or every cost, even if it's in your loan. So, section B, it's going to list FHA upfront mortgage insurance. Now, all the way in the bottom right hand section where it says calculating cash to close, it's going to say something to the effect of like fees or costs financed into your loan amount. It should be the exact same number as what's in section B, but a negative. So if up here it's $4,000, it'll be negative $4,000, showing you that it is a fee, but it was taken out of your loan amount. So you're getting a credit for it that gets pushed into your loan. So they're not going to charge you twice, but they do have to itemize that fee for you to disclose that it's there. When is my book coming out? It's a great question. I don't know what I would write a book on. I feel like writing a book on buying homes would be boring. I don't know who would read that. Maybe, maybe I'll have to write a book on buying homes. If you pay 20% down on an FHA loan, will there be mortgage insurance? Yes. So FHA loans have mortgage insurance for the entirety of the loan unless you put 10% down, then it falls off after 11 years. Dumb rule. Don't know who makes all these rules, but they're fun to keep out with. Okay, Adam. Man, I could go about this topic for a long time. So, you said watching some of these videos is kind of depressing. So you're 14, don't think you'll be able to afford to buy a house when you reach adulthood. So, man, I feel where you're at, and trust me, so do thousands, hundreds of thousands of other people. So the really stressful thing um, is the fact that this channel even has to exist, right? The fact that the mortgage process and the home buying process is so confusing on its own that we have 144 people here right now who are trying to find out this information for themselves. Um, that the complexity coupled with the fact that over a historical period of time, over the past 50 plus years, we've seen home prices increase exponentially, but we haven't seen minimum wage increase. We haven't seen other signifying indicators that would say income is also increasing along with home purchase prices and with appreciation or I'm sorry, with inflation as well. So what's ending up happening is it's more and more difficult to purchase. And that's where kind of the whole joke about like millennials not being able to afford things because they're like buying avocado toast is it's funny, and that's not the true cause, right? Because buying a $5 piece of toast isn't changing your ability to purchase a home. So I'm completely with you, and I don't have a remedy for you, honestly. But just know that like I'm with you. So are hundreds of thousands of other people. This is a large issue that I think we're going to face in the U.S. for a long period of time. The best thing that I can say to you would be, you know, do what's going to be best for you in the future. Uh, don't purchase a home just because people say you have to purchase a home, right? You can budget and you can do everything right in your world and in your space, and that's what I would focus on. Um, Trying to not be concerned with these external factors, just trying to say, what can I do internally that's going to make me happy, that's going to bring me joy, that's going to contribute to a more generative and transformative world around me. So, hope that helps. I think I got a little esoteric there, but okay. And I'm trying to grab every question that I can here, so I'm so sorry if I miss it. What should your credit report look like for qualification? You see people with high 700 FICO get denied, um, and one with 650 get approved. So your credit report, mainly you want to show the lender that you have your credit report is kind of like the story of how you borrow money. So you want to paint a good story to an underwriter that you have the ability to pay back debt, and you pay it back what they would consider responsibly. So if you're seeing people with a high credit score get denied, it's probably not because of their credit. It's most likely because of something with maybe their debt to income ratio. Um, so there's a lot of other factors that go on. I think the two biggest factors that happen or that go into getting qualified is your credit along with your debt to income ratio. Those seem to be kind of the two big players in you being able to get approved. Mm-mm-mm. Miriam, you said it's so glad I made it to this live, and I am glad you made it to this live as well. Let me know if you have any questions. And again, if I haven't been able to answer your question, I'm so sorry. I'm trying my best here to get to everything, to get to every question as I can. With house hacking, would you include the potential income from the second unit in the yearly income on the calculator? What I would do, it's a great question. This calculator isn't really set up to do that, but here's what I would do is let's say, let's put in your income. Um, let's clear this out. I wouldn't put it up here. What I would do is I would kind of, mess around with the sheet a little bit. So I would say rental income, and let's say your rental income is $1,000 a month. A lender is only going to let you use 75% of that. So take whatever your rental income is times 0.75. So we're actually going to use 750 and just put in the minus sign and then 750 to calculate it as income. All right. So that's going to offset that mortgage payment for you. Then you want to make sure that you put in uh, whatever your down payment and all that stuff is down here. And then obviously, jump back from this really aggressive, these really aggressive numbers that I was putting in there. But putting in a negative number is actually going to count as income. So in the calculator, it's going to work the same way there for you. Tish, you said, what are your thoughts of owning for a loan? Um, could you clarify? I'm a little confused on the question. All right. So you live in Washington, D.C. and moving to North Carolina. You work remotely. Would it be an issue getting a mortgage for home at the new location? Although my work is in a different state, getting a mortgage for home at the new location. So if you work remotely, all you'll need is a letter from HR or your employer to say that you work remotely, and a lender will be able to use that income, even though you're moving to a different state. As long as they say somewhere in the letter that moving from state to state isn't going to change your work or your employment or your income at all. Will I be able to get a mortgage with 10 hard inquiries on my credit report? Absolutely. So, how many inquiries you have is not going to impact your ability to get a mortgage. Mhm. So, what's the benefit of going FHA versus conventional? As far as qualifying, FHA is a lot easier to get approved for than conventional. Now, a good example of going FHA over conventional is, let's say you have a 640 credit score. With a 640 credit score, technically you could get a conventional loan, but it's actually more financially beneficial, even with mortgage insurance and upfront mortgage insurance, to get an FHA loan with a middle credit score. So we have kind of on our back end, and I'm trying to build a loan comparison calculator for you. It's a lot more work than I anticipated. So you can kind of play around with these numbers on your own and compare loan estimates. It's going to be a little out in the future, but we have software on the back end that allows us to compare loans side by side. And anytime I've priced a loan that's had like a middle credit score, like a 640, comparing FHA versus conventional, FHA is always the better option, almost always the better option than conventional, even though somebody can qualify for conventional. So FHA is going to be better for your middle to lower credit score, and conventional is going to be better for normally a credit score that's going to be about 680 and above is where conventional starts being a better option. Conventional tends to like it almost seems like penalize you if your credit score is below a 680, and you get kind of penalized by having a higher interest rate. Okay, so you want to know what my thoughts about a company called Owning? Okay, I have no clue who that is. Owning Loan. Let me look them up real quick. Owning Real Estate Buying and Selling Program. I honestly have no idea. I'd have to do some more research. I've never heard of them. Brad, how do lenders see commission-based income? Both my wife and I started new jobs about a year ago in sales. We make around 12,000 a month. Oh, it's awesome. It's all commission. But it's consistent income, however. So with commission, it's going to need to be averaged over 2 years. Okay, so it's kind of similar to how lenders going to look at self-employment. It's a lot less strict than self-employment, but they need to see a 2-year income. So it's going to be difficult for you to get approved with only 1 year of commission-based income, no matter how high. I've never seen it happen yet. It's very possible a lender could do it for you, but I just haven't personally seen it. All the guidelines I've read say 2 years. What's my prediction for the next housing crash, and what decline in home value do you predict? So, man, I've been so conflicted on this. So on one hand, I see I see all of these people making videos about like predictions on the housing market and what's happening with what they think is going to happen with the housing market, and they're getting thousands and hundreds of thousands of views. And I'm thinking like I can make a video on this. But on the other hand, I have this like ethical problem with it. And maybe it's not valid, but I just personally have an issue with giving predictions, because it's just not the way the market works. And I don't think it's fair to necessarily predict something. What I do think is fair is to be able to talk about historical data compared to what we're seeing now. Um, so I don't know. I just have some reservations of trying to give predictions on, housing, what's going to happen with housing markets, because I don't want you to make decisions based off of my opinion. And I don't want you to make decisions based off of anybody's opinion. You're going to have to make a decision based off of what's right for you right now, based on a plan that you have. So that's just kind of personally where I'm at with it. But as far as housing crash, uh, what's happening right now is nothing close to what was happening in 2008. In 2008, it was kind of like a house built on sand. You had all these really awful and fraudulent loans. That's what led to a housing crash. Right now, we have really solid loans, that are performing actually really well in a pandemic. There's surprisingly very few missed and late payments. That's largely helpful because of forbearance. But I don't think we're going to see a housing crash. Right now, we're in a bubble, right? Home values are increased, but a bubble is different than a crash. What we would most likely see is a correction, right? All markets have this like cycle, right? Kind of like waves. Things go up, things go down, things go up, things go down, and over time they tend to trend in one direction. Um, and what we're going to see most likely is a correction in home prices. but a crash would be indicative of like a really bad financial economic position for us as a country. I just don't anticipate that happening um, in the near future, at least not based on like statistical data that I've seen. I could be wrong. If we have a housing crash, at least I didn't like definitively say what's going to happen. Katie said my realtor told me it would be better for me to qualify for a conventional loan versus FHA. Does it really matter for the buyers or overall cost? Um, yeah. So if your credit score is higher, conventional loan is normally going to be your most or give you your most savings, but a conventional loan is a lot more attractive to a seller than an FHA loan. FHA loans have a little bit more red tape when it comes to what condition the property's in, and they're perceived as being slower, even though they're not. But they're perceived that way. So conventional loans can be way more attractive to a seller and will be cheaper for you with a higher credit score. When and why should someone use a broker over a bank or credit union? Um, a broker is going to be beneficial. Let me give you a little bit of history. So, like, brokers used to be kind of mainly used for like niche loans. So, loan products that just didn't work with other banks. Banks and credit unions used to be a lot more strict in the requirements, and brokers used to be a little bit more lax. With all of the intense regulations that have happened since the housing crash, the playing field's pretty even. Everyone pretty much has the same loans, right? Banks, credit unions, brokers, everyone pretty much has the same stuff. There's not a lot of like differences between the programs that they have. Now, brokers do have access to some programs that banks might not, and banks might have access to some programs that brokers might not. So, really, what it comes down to at this stage in our economy is uh, the models are different. The actual like organizational model of each is different, not necessarily the product. So, here's what I would suggest, just to simplify it. I would suggest getting a quote from a credit union, a bank or a direct lender, and a broker. That's going to give you the widest spread of options so you can see everything that's available to you. Um, even though I'm a broker, I'm not going to sit here and tell you broker is going to be your best choice because if a credit union or a bank gives you a better loan option, then I would go with that. Right? I don't have this undying loyalty. Is that real? I don't have this loyalty to the brokerage world. I personally think it's an effective model. But if you find a better loan option for you, I would go with that. So shop that wide net there for you. Okay. Let me make sure. Let me see what I'm missing here. What credit monitoring service do you suggest to consumers? So right now, I don't have a good suggestion. I kind of hate them all. And that's not helpful at all, is it? Um, the one that I like the most, I guess, is I have a Discover card and they do like credit monitoring stuff and, tell you if anybody takes stuff out. Um, all of the other ones just kind of annoy me because they are just so aggressive with wanting to like sell you stuff. Um, and the thing that's awful too is like all soft pull credit monitoring services, no matter who it's through. If it's a soft pull, it's not going to be fully accurate to what a lender is going to pull for your actual mortgage credit score. So um, I don't think you're going to go wrong. Like you're not going to get one that I feel like is going to be so much more accurate that it's going to change your decision moving forward. Like going with Credit Karma over something else, I don't believe is going to make you have a smoother plan or make things more actionable. What I think these credit monitoring services do is they help you see one, is there any like fraud going on? But then two, it shows you the momentum of your credit score rather than like what your score is. So I would use these services to see like, is my score continuing to go up or is it continuing to plateau or is it continuing to go down? But not like, what is the exact credit score? I think you're just kind of going to waste some energy trying to chase around who has the best credit monitoring service. But that's kind of my opinion. I don't I don't really use any of them. I think think I might have unsubscribed from Discover's credit monitoring emails anyway. I don't know. Maybe I shouldn't. I'm sure like next week someone's gonna take my identity, and I should have stayed on top of that. So Marvy, you said Dave Ramsey makes me feel like I won't be able to afford a house ever. Yeah, I understand that. And again, this is just one of those things where I think in life we want to feel like there's one solid, concrete answer, and that if we finally find the answer to something, then everything else is going to fall in line. And some of the frustrating pieces about, I really like what Dave Ramsey has to say, and I think he has some really great advice. But when you take one person's opinion as this is the only way of life in anything, whether it's home buying or just life in general, it usually ends up just leaving us feeling more disappointed than anything else, because life just frankly doesn't work that way, where everything falls into line into one categorical thing. So what I would do is I would take pieces of his stuff that you really like, pieces of his stuff that are helpful to you, and then create your own plan with that, right? So he might have some really good suggestions for you as far as uh, creating an emergency fund and paying off credit card debt. But his suggestions as far as what you should pay for a house might not be helpful for you. And if that's the case, then that's okay. You can take the good stuff and throw away the rest. And then you can come over here, take some of the good stuff, and throw away the rest. You can take some of what I say and then throw away the rest. You don't have to follow everybody's opinions exactly. And that took me a long time to learn because I so want there to be a right answer that I could just find it and then everything falls into place. But unfortunately, that doesn't happen. Red Panda said, "Thanks for the videos. I feel pretty good buying a house. Close November 2nd. Awesome. Well, congratulations. That's coming up here pretty soon. Well, you're going to be a new homeowner, which is awesome. I'm so glad the videos have been a small piece in helping you through that. Where do you recommend keep your money for savings for a down payment? Savings, CD, investment funds. Definitely do not invest in funds. Just keep it in a savings account. You're not looking for this money to grow. This money is not an investment. So just keep it in a savings account. It's going to be a good place. You don't want to invest it into a fund because, of course, funds can go up, but funds can also go down, right? So I wouldn't want you to put it into a fund and it lose money while you're trying to accumulate savings. How soon can you buy your dream truck after closing date? As soon as you close on the loan, you can purchase whatever you want. Okay. An underwriter is not going to look at that loan anymore. You're closed, you're done. Go purchase whatever you want. Take your debt to income ratio to the sky if you want to. I actually don't suggest that, but you can if you want to. Okay. So I was laid off in March, but started a new job. And a side note, if you're watching the debate right now, you want to put in the chat how's it going? I'd be curious to hear an update. Obviously, let's try to keep everything civil in the comments here, but I'd love to hear whatever drama happened or whatever new flies got introduced to the debate here. So, okay, I was laid off in March, but started a new job in a different industry and at a much higher salary. Awesome. In August, hoping to purchase in February. Will this impact me? Nope. You'll be perfectly fine. So March to August, no issues at all there. You'll probably just write a letter to the underwriter saying, hey, I was laid off, and that's about it. Got Adam saying, "Ain't nobody watching that mess." That's fair. Well, I'm glad you all are here instead of keeping up with that drama. AJ, what a good question. I've never been asked this yet. Should you pick a loan type before underwriting? And also, can you change loan type after underwriting? Yes. So you have to pick your loan type has to be decided before underwriting, um, because you're going to have an underwriter normally specific to a loan program, right? There are underwriters who only work on FHA loans and only work on conventional loans and only work on USDA loans because the guidelines differ between them all. So normally underwriters specify within one loan type. Now you can flip it over to another program if you need to, right? If you could have a conventional loan right now, and then you know, let's say some reason insurance comes back high and your debt to income ratio is too high, and you want to flip to an FHA loan, you can do that. You'll ideally want to do this before the appraisal happens because you have to get a specific appraisal for each loan type. You can't use a conventional appraisal on an FHA loan or vice versa there. Is it vice versa? Vice versa? I don't know. Why do we have these little Latin phrases that we use and mix into English? Any suggestions on interviewing lenders? Um, I've been wanting to work on a video about this. To me, what I would want from a lender is, I'm going to steal this line from Dave Ramsey, but somebody who has the heart of a teacher. You want somebody who's going to educate you through the process, and not feel like, you don't want to reach out to them and then feel like they're just trying to brush you off. Now, again, understand that, like, as a loan officer, you're getting calls all throughout the day, right? Like, I'll get calls at like 11 at night. Okay. Um, with It's like at some point I need to be able to rest and relax. I can't do houses all day, every day. It gets wildly obnoxious. So obviously you're not trying to monopolize the lender's time, but if you reach out, if you send an email or a text, I would want a lender who is willing to explain things to me if I have questions. So the best way to interview somebody, really is just to ask questions and see what those answers look like, and then your gut's going to help you figure out if this is somebody who has the heart of a teacher, who you feel like you can trust through the process. Because the last thing you want is to get approved, and then have a rough experience because you don't have any contact with your lender. Because unfortunately, that happens where lenders just disappear on people. I don't know how that works or how people do that, but it does happen. And I'm gonna go grab. I should have brought some water here with me. I'm gonna go grab some water. So I'm gonna be back. Give me like 2 minutes, 3 minutes here. All right. I totally should have been more prepared and had some water over here or something. Oh, it's so unprofessional of me. I would never I would never make it on the news. Okay, Will, you asked, why do sellers look down on VA loans? Man, this is so true, and it's so unfortunate. So it's a combination of factors. One, it just depends from like a history of uh, how VA loans used to work. VA loans right now are fantastic. I love working with VA loans. They're great. They're a great loan program. Um, but VA used to be incredibly slow. VA loans used to be slow and difficult, and sellers didn't want to work with them. So that has bled into like our current time. People still have that mentality, um, or at least inexperienced realtors have that mentality with VA loans. And unfortunately, most of the realtors that you're going to run into, just like most, don't have a ton of experience closing homes. Um, like the interesting thing about like a loan officer versus a realtor as far as experience is, like, a loan officer gets paid less than a realtor. So a loan officer is going to normally do a lot more transactions than a realtor would. So we normally get a lot more experience going through several transactions compared to a realtor. So to make the same amount of money, a loan officer normally is going to do 2 to 3 times the amount of deals that a realtor is going to do for the same income. So, and loans are easier to close than finding a buyer or finding a seller and making that transaction happen. Um, so most realtors just aren't familiar with VA loans as much as a loan officer might be. But VA loans are fantastic. The only complaint that I have with VA loans recently within the past year is it seems like the appraisals on VA loans keep coming in a lot lower than the conventional or FHA side. And I don't know if that's just my perception or if there's any truth to that. That's just what I've been seeing. It seems like VA loans keep coming in lower. And I don't know why. And every time I talk to an appraiser about it, they just say it's to protect the veteran, which I understand and I respect and I appreciate, but it also harms the veteran because now they've lost their appraisal money. Now they're trying to figure out what to do with a home purchase, and so it's just this complicated thing. So VA loans really are fantastic, but sellers unfortunately tend to not like VA loans because their realtors are going to convince them to go with another offer. What do you do when the appraisal comes lower than the home purchase price? Uh, Probably open a bottle of wine. That's at least what I do before I make that call to somebody. um, so when the appraisal comes in lower than the purchase price, you have a couple options. The first option is to ask the appraiser if they'll reconsider the value. Um, I've never seen this work. It's an option just because I think it's an option. Uh, I've seen it happen once, and the appraiser increased the value by $1,000, which was basically a slap in the face. Um, I would have rather him not changed it at all. So, since that's not really an option, your other option is you have kind of three other options here. I keep saying the word option over and over again. So, you could either come up and bring the extra money to the closing table. The seller could decrease the purchase price that amount, or you can meet somewhere in the middle. And then finally, an option that not a lot of people know about is you can actually change lenders and get a new appraisal done if it's a conventional loan. If it's a government loan, USDA, FHA, VA, it's going to stick with the property normally for about 6 months. Um, but if it's conventional, then you can actually change lenders and get a new appraisal. No guarantee it's going to come in at the value you want it to have, but it's an option if you want to. Um, can you explain the underwriting process? Man, that is a big question. I do have a video on the underwriting process. I think I have a couple of videos on them, so I just suggest looking at those. But underwriting basically is going to be an underwriter is going to verify everything you said on your loan application. So you have your loan application, and then it's going to be submitted to an underwriting software that's basically going to say thumbs up or thumbs down. If it's a thumbs up, it's going to go to an underwriter, and an underwriter is going to want to verify everything in your loan application that was fed into the software. So they want to make sure if you say you make $50,000 a year, you actually make $50,000 a year. Normally, it's the software that's going to be doing the actual underwriting. The underwriters are doing mainly the verification of what's being entered into the software. And there's some circumstances where you can do like a manual underwrite without the software, but we won't get into that. That's not exciting. And I do have a video on getting a loan with no credit score that explains manual underwrites. Currently with underwriting or underwriting, they asked me to fulfill my conditions. I have. How long does it take to hear back from, I'm guessing from them for clear to close? So if you submit all your conditions, I would expect you to hear back from the lender as long as they have everything else within a few days. Oregon has a housing center that offers classes on house buying process. connects you to lenders and realtors and helps with the whole process. Do you think it's worth going through them? Yeah, I think it's worth sure trying it out if they're going to give you some free resources. As long as they're not going to like charge you or steer you into anything, then I think that would be an okay thing to check out. Having a realtor helps with finding lenders and all that. It's hard to find that local field of out of state would have to change banks. Um, I see what you're saying. Yeah, a realtor recommendation is always going to be good with a lender because a realtor probably has some experience working with a specific lender that they would recommend. Um, as far as finding a lender, I am planning on making some videos on that. That will be a lot more detailed. But it's really going to come down to the same process with a realtor. You're going to have to interview and talk to some people because uh, what I've tend to find in this industry is like uh like and this is not a fair statement I guess, but good loan originators usually aren't good at technology. So the people who have like really flashy websites are normally big corporations and big companies, and the ones who are just like really good at what they do probably don't have the nicest looking website. So you're just gonna have to probably talk to people, either email or text or call and interview some loan officers. If you're retired wanting to buy, do I need to show income if someone pays income to you? So you'll need to show income on any loan, and income can be income that somebody pays to you in some capacity, or maybe it's a pension or social security. So as long as you can show consistent income in some form, then you can use that to qualify on a loan. Tips for a new LO. Love the channel. What you do? Thanks. So for a new loan officer, mainly what I would suggest, and I think I mentioned this earlier, is try to find something that helps you stand out a little bit because especially if you're trying to work with realtors, it's hard to differentiate yourself, right? A realtor is going to say like, "Why are you different than any of these other loan officers who keep calling me and wanting to ask me to coffee and whatever?" So what I did is I really pushed into using video. So like every loan that I did, would send two personal videos, sometimes more. So one when someone was pre-qualified, I'd send them quotes with a video that walked them through like, here's your quotes, here's the numbers, here's the best loan option I think for you, and here's what's next. And then a second one when they got their loan estimate, I'd walk through that with them as well. And normally that's super helpful for people because they're going through a extremely overwhelming process. So it's nice to have someone walk through that with them. So if it's not video for you, find something that's going to help you stand out. What do you offer to people that other people aren't doing? And frankly, it's pretty easy. The bar is set pretty low. I've also found something that's helpful is using a tool like Mortgage Coach or MBS Highway. What that will help you do is compare loans side by side, and you can present those to clients. So you could take multiple different conventional loans or FHA loans, or compare different ones side by side, and help them see which is going to be the cheapest loan option for them. Those would probably be two things that are going to help you out a lot, and help your clients out a lot too. Um, Currently under contract with my first house. How late can I go and still switch lenders? I'm still a few weeks out from closing, but I've been quoted better rates with other lenders. Really, I mean, legally, you can change whenever you want. The main thing that you want to keep in mind is that you're meeting your contract dates. So, if your purchase contract says you're going to close on a specific date, you have to follow through with that, or you have to let the seller know and get an extension on your contract. So if you're going to talk with another lender, let them know, hey, this is when my contract closing date is. Are you sure that you can hit that date? Because you don't want to just like change, the week before closing, and then tell a seller like, well, it's going to be another 30 days. The seller is going to be a little upset, I would imagine, and might not extend the contract for you. Are approvals based on a middle FICO or as long as a one bureau has the 640? It's going to be the middle. So that median FICO is what they'll use to qualify you with. Okay, hey Kyle, can you please explain gift fund guidelines for a FHA loan? You had a close friend gift fund me to pay off debt that was a roadblock. Now my loan is in process. Uh, any concerns? You had a friend gift fund you to pay off a debt. Hmm. I don't know that that would be allowed. FHA does say in their guidelines that you can have it can be a close friend, but it's extremely difficult to have an underwriter approve a close friend. Um, so it really just depends on the underwriter themselves. But as far as like general gift fund guidelines, um, it's obnoxious. So they're going to want to see your bank account with the gift funds in it, normally a copy of the check or the wire that was sent, and then they also normally want to see a month statement of your of the donor's account to see where the money came from, and that's all in place not only because they want to make sure it's the loan or you're not getting a loan for the down payment necessarily, or if you do, they want to document it, but this all came into play after the Patriot Act came in, and the government had kind of a far-reaching hand into exploring money laundering and terrorism. So that's why you have a lot of these strict rules with assets and mortgages, which can be a little obnoxious, but it literally all comes down to like what happened with the Patriot Act. So it's obnoxious. It makes people upset, and I get it, but it's the guidelines. Um, could it be possible the appraiser is just a jerk and is undercutting the seller for whatever reason? Sure. Yeah, I mean, I would hope not, but yeah, there's some appraisers it seems who just consistently have low appraisals, and the thing is, like, the way appraisals are created is it really does come down to you have an opinion and you're justifying the opinion, and so if that's the case, you can make arguments for a lower price or a higher price. And so, I mean, my hope would be that appraiser isn't just intentionally kind of throwing people out of a deal, but I guess it's possible. Does the software automatically gross up SSDI income? I'm guessing, are you talking about like the Google Sheets? Because no, it does not. So if you have Social Security, disability income, or even just regular Social Security income, what you'll do is you'll gross it up by 1.25%, 125%. So what you will do is take your income. Let's say I don't know. Let's say your SSDI is 1,500 a month. So let's convert that to yearly. That's 18,000 yearly, and we'll multiply that times 1.25, which gives us a yearly income of 22,500. Is it possible to use an FHA or USDA loan to purchase a sub $60,000 home? You sure can use both. You can also use a conventional loan to purchase lower than that. Okie dokie. Can you spend money while in underwriting, such as grocery shopping? Yes, absolutely. Yeah, you can still do everything normal in your life. The only thing you don't want to do is go take out new debt. So spending on your credit card is, okay for normal things. Don't go put an extra $1,000 on your credit card. Don't go purchase furniture and stuff on a credit card. Don't go get a new car. Don't open new accounts. Just make sure you don't do anything with debt that's too big. Everything else perfectly fine. So will lenders count unemployment checks towards your income? No, they will not. Unless you've been unemployed, receiving unemployment for 2 years, you'll need 2-year history for that unemployment for it to count towards an average of income. But you will need to have regular employment to qualify for a loan. So the only time when unemployment is going to be used is like let's say you have a seasonal job, so you work a couple months and then you file for unemployment the other months. As long as you've been doing that for 2 years, a lender can use it. But if it's only unemployment, then they won't be able to make that work. At what percent of a down payment would you recommend a buyer begin the pre-approval process? Really, you can start at any. I think you're kind of asking like how much money should you have saved up. I would suggest, I mean, at least the minimum. Personally, I think it would be good to have around 5% saved up as kind of a minimum, even though you can do a little bit lower with most loan programs. But I think as long as you have that money going, it's going to be easier to work with with a lender. Sometimes what can happen is it can be difficult to work with a lender if you don't have, if you don't have money in your bank account, and if everything's just kind of like this disheveled thing and you're throwing it at a lender, you might not get an eager response from them. Um, right. So either be honest and upfront with them, say like, hey, I'm not ready, but I'm just asking for your help here. Or if you are wanting to get that approval, then make sure you have that money in the bank account and they know that, so they know that you're a serious buyer, or a serious borrower that they can work with. Gretchen, you said switch over to the debate for a few. You aren't missing anything. Same stuff you've already heard before if you watched the first debate. Oh, so yep, not missing much, except just like increased anxiety. Oops. Okay, so you said, I'm a notary signing agent. I see a lot in a lot of the refi packages, a form stating the lender can check on your financials the day of closing. Do they really do that? Yeah, with COVID, lenders are being a lot more intense with their verifications of employment. Now it's laxed a little bit, but I know some lenders that were verifying employment like 3 to 5 times. So not only are they asking for income documents like pay stubs and W-2s, tax returns, but they also would get a verification of employment. So having your employer sign something about how much you make. And then they would call multiple times through different stages in the process. Sometimes some lenders were requiring day of verbal verification of employment. So like you're going to close at 3 p.m. today, and the lender is going to call at like 12 and say like, hey, does Johnny still work here? Which can be really stressful because you have these, departments and these lenders who are going out and they'll hit a voicemail and they'll be like, okay, on to the next one. It's like, no, 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 we're closing in 2 hours. We need to get this done. So it can be really, really stressful, but lenders are laxing up on that a little bit now that everyone's a little bit more uh, comfortable with how COVID procedures are planning out. Like in the beginning, everyone was freaking out because we've never experienced this before. But now that everyone's a little bit more comfortable, it's laxing a little bit more. And I expect it's going to continue to lax unless we see some crazy second wave come. And uh, at that point, best luck to everybody because it's going to be a wild ride, I think. You said you've been eating a couple noodles because I was scared to shop. Oh my gosh, go out and get yourself get some ice cream or a pizza or something. Go Oh, that's great. Yeah, you absolutely can go spend money while you're in the underwriting process. Just don't go take out a bunch of new debt. So, go get something more than a cup of noodles here. Um, all right, so you live in an expensive city where I cannot afford a house. Do you recommend buying and renting the house till I move? Do I recommend buying and renting the house to I think I'm a little confused. So you can't afford the house if you can afford to buy it. Um, if If I misinterpret the question, let me know. Um, what you're asking. I think interest will go back up after the election and the market will cease. It's so hard to say. Um, so one thing to keep in mind, and this is kind of an easy way to think about how the whole interest rate thing works in combination with the economy, is first we have to realize that the stock market and our economy, pretty much, I should say our economy, the stock market is almost entirely fear based. As much as we want it to feel like it's about strong companies, it is all about fear, and all about sentiment of how things are going to move. So when investors like what's going on in the economy, the stock market goes up. When investors don't like what's going on in the economy, the stock market goes down. And mortgage interest rates follow the stock market in the sense that if stock prices go up, uh, interest rates actually go up because people are buying. People don't want the bonds as much, so bond prices become more expensive. Um, and I'm sorry, bond prices actually lower, and then interest rates increase. So it's kind of this weird play, but um, it's so hard to say what's going to happen with the market depending on the election. Um, it's so hard to say. I could speculate, but it's not going to be helpful to anybody. All right. Is there ever a scenario where you would recommend the buyer to buy down a point? Um, I think a point is okay if you're planning on being in the home for. I mean, obviously, I'd pull out a calculator to do this, but if you're going to be in the home and not refinance for maybe 3 to 5 years, I think a point is fine. Anywhere above a point is where I start to really like ask questions on, is this really a smart decision? Um, I think buying a point now is more beneficial than buying a point a year ago, right? We're at like crazy low interest rates, and I don't expect interest rates are going to continue to decrease, um, much further than they are right now. If they continue to decrease down into like the mid to low twos, we have a bigger problem in our economy, um, than than just mortgages. So it really depends. As long as you're not going to refinance or sell, uh, within the next 3 to 5 years, then I think a point is okay. Any more than that is where you're really gonna have to say, like, are you going to not refinance for the next 7 plus years because you'll lose money if you refinance too early when you pay points. So you got a commitment less than you for less than you asked. What could be done? Um, so first, what I would do is get a second opinion from another lender, just to double check, see there. I would also explore changing the loan program. So maybe that was on a conventional loan. With an FHA loan, you could probably get qualified for more. Another option you can look at is adding a co-borrower. So see if you have like a family member who would be willing to co-sign on the loan with you to increase income. You could also, I would talk to the lender and say like, hey, how much more wiggle room do I need to get to this purchase price? Um, but it really is just going to depend kind of on where you're at with your situation. So your loan officer said they'll be verifying your employment 48 hours before closing due to COVID. Yes, yes, they most likely will. They definitely like to do that. Do the score approvals ever change? It was a 620 score to get approved in 2015. Does the minimum score change yearly when getting approved? It's been 5 years since I bought. Um, Sometimes it just depends if they change the rules. So 620 is still the minimum on a conventional loan. An FHA loan, USDA loan, and VA loan will actually go all the way down to a 500 credit score, which is pretty low. So, but 620 is the minimum for a conventional loan. If the lender pulled credit twice already and the closing date was extended 10 days, will they pull it again? I'm guessing I would want to know why they pulled it again. They probably pulled it again because maybe the first one expired, because they normally expire every 90 days. So, will they pull it again? Probably not, as long as it doesn't expire. I would just ask the lender, uh, why did it get pulled again, um, and see what happened there. What exactly are they looking at in the underwriting stage? They're going to verify that the information that you put in the application is accurate, and not in the sense that like you're going to get in trouble if your income is off by whatever amount. They don't care about that really. Um, what they're mainly looking for is seeing like, hey, if the underwriting software approved you when you said you made $50,000 a year, but you actually make $43,000 a year, uh, are you still going to get an approval at 43,000? That's mainly what they're checking. They're just verifying those facts and that it still fits within all of the underwriting guidelines. And they're going to look over your documentation to make sure everything kind of matches. Like, does your employment meet the guidelines? Do your bank statements meet the guidelines? Do you not have like non-sufficient funds and overdrafts and stuff like that? You're in the process of getting a home built. You've given a deposit to the builder and signed paperwork, but the home is not started in the build process. You're also in underwriting with the lender. Yes, it's normal. And building right now is taking a lot longer than normal because of COVID. Somehow messed up everything. Somehow this thing has just completely altered all aspects of life in crazy ways that I guess we didn't anticipate. Okay, so you said the second one was a soft pull. It's possible they could do another soft pull. The soft pull is just to make sure you didn't go pull out new debt. And as long as you haven't pulled out a bunch of new debt, then you'll be okay. Are all states the same approval guidelines the same? You're in Tennessee. So for the most part, um, there are some states that have very small differences. For instance, I think it's like North Dakota or something requires 20% for an escrow, and all other states require 5 or to waive escrow. There's like very minute changes that shouldn't impact you very much, at least not from a like actual how much you qualify standpoint. It would just be little nitpicky things like escrow accounts and things like that. Okay, can a Canadian buyer build a house in the States? If yes, what are the requirements? So you would need a foreign national loan is what that would be called, and they have a lot stricter requirements. I've never done a foreign national loan before. Normally they're, I believe, 10% down. There's just a lot more restrictions with them because they're riskier to a lender. So, but what you're going to look for is a foreign national loan, and only a few lenders have them, so they can be a little bit difficult to spot. Hello. All right. So I just started a business. It'll bring about 45,000 a year. The company only has 2 members. Can I count that income when applying for a loan? I have a regular job also. So you cannot count that income until you have it for 2 years, since I imagine you're self-employed. Um, so yeah, you said you started the business. So I imagine you're like an owner of this business. So you'll need that for 2 years to average that income to be able to use it on a loan. Oh, okay. I see what you're saying. So you said I cannot afford to buy a house where I live, planning to buy my first house in a cheaper city, rent it for now, while continuing to live in a rented house. Uh, what I think your easiest route would be to live in the house that you purchase in the cheaper city, and then after a year you can move out and rent it. If you get a rental right now, you have to purchase it as an investment property, which is going to be a higher down payment, higher interest rate. But if you purchase it as a primary residence and you live in it for a year and then rent it out, you can go with a lower down payment and a lower interest rate. But I think that's a good plan, because some of these cities are just so ridiculously expensive to live in that it's like I don't even know if it's a good financial choice. unless the values just continue to appreciate. So you only have 16-month job history in your current field. Will you still qualify for a loan? Yeah, that's perfectly fine. Normally, you'll want to see if you're switching like job fields. Normally, a lender wants to see about 6 months in that field, and if it's any less, they want to normally have some documentation on like, uh, do you have certifications or do you have education that would lead them to believe you'll be fine in that field. But they want a 2-year history, but it doesn't mean that 2 years all has to be in the exact same field. Will I have to show the underwriters my business bank accounts? No, unless you're getting like a bank statement loan for self-employed. But as long as you're not doing that, then no. Unless you're paying for funds out of your business bank account, then yes, you will. But for any other circumstance, no. If you haven't worked for 3 years, how long do you need to have a job to be considered for a home loan? Normally 6 months. What are they looking for on bank statements? The main thing they're going to look for is large deposits. So uh, this is technically in the guidelines as any deposit that is 50% or more of your monthly qualifying income. So if you make $5,000 a month, a deposit of $2,500 or more um, is going to need to be documented. So they need to see like, where did that money come from? Why are you getting this money? Is this part of your terrorism? That's mainly what they're looking for. The other thing they're looking for is, do you have overdrafts on your account? Because if you think about it, like someone who's about to give you money, if they see that you've overdrafted your account before, they don't want to give you money because you overdrafted it. So that's mainly what they're looking for is large deposits and any overdrafts. Okay. Accessory. Oh yeah, you said your dad was not okay with it at first because of the year worth of bank statements. Yeah, I anytime I've had to document gift funds, really documenting bank accounts in general, people are not happy, and I get it. Um, just know that like when a lender is asking you for documentation, it's not it has nothing to do with you. It's nothing about you personally or what they think about you. It is purely just a guideline thing. Because in the grand scheme of things, what's going to happen is your loan is going to be in a system with thousands of other loans, and auditors are going to sort through it and pick a loan and just randomly see, what's happening with it. So it's not a personal thing for them to get your bank statements or ask for them. I cannot tell you the amount of like uh, people who have been angry at me when we have to document gift funds. I can't tell you the amount of like fathers I've been on the phone with who are yelling at me because we had to ask for their bank statements because they gave a gift to their child. It's the guideline. I can't change the mortgage rules. I'm sorry. I don't want to ask for it, but it's the rule. If you want a loan, you have to follow the rules. Somebody is willing to give you hundreds of thousands of dollars, or potentially just tens of thousands of dollars. You have to play by the rules if they're going to give you the money. So it's not a personal thing, but it is frustrating. I get it. You took time off to finish a degree and certification. How will that affect your qualification for a loan? So, if the job is in the thing that you got a degree or certification for, then you can use that as your employment history. So, no problem at all. The lenders look at net or gross income for self employed. They're going to look at your net business income. You can add back depreciation and depletion, and you can add back the depreciation portion of your mileage, which is 26 cents per mile. How do you find out if you qualify for a USDA loan? Best thing to do is contact a lender, preferably a local one, and see if they have USDA loan programs and ask to apply for one. So the underwriter is not going to care where the money and the savings came from. They will. I'm not sure if you're referencing a past thing. Oh, okay, I see. You're referencing, like, the money that came from your business. As long as you can document it came from your business, you can use the money for the down payment, but you can't use it as qualifying income. Christian, you said, "My brother and I attended university 4 hours from our house in a small city, and we're wondering if buying a house to avoid a rent during the school semester and rent during the summers would be smart." I think that's a great decision, especially because, like, uh, there's probably a lot of people around there because it's a college town, um, or most likely a college town, like, that there are gonna be people who need to be there just for the summer because most cities, it's hard to find people who are just going to rent for the summer. So that could be really beneficial for you. Just make sure that you're either willing to commute if you need to, or you have somebody locally who can help, fix things in the house if needed. Cool. Well, we've been at it for about 2 hours here. And I'm at the point where my voice is feeling all crackly. So, um, I need to hop off of here. But, as always, if I didn't answer your question, what you can do is you can comment on any other video, and I promise I will answer it. Might take me a couple days. But thank you so much for joining. I hope you all take care, stay well, stay safe, wash your hands, wear a mask. And I'm super thankful for you all. And keep asking your questions, and I'd be glad to help out. All right. Have a great night.